A leverage ETF seeks to generate double or triple the daily performance of an underlying investment, such as an index or commodity. So when the underlying investment increases, a 2 times leverage ETF will generate about twice that amount before the management expenses and commissions. While these types of ETFs can magnify the gains for an investor, leverage ETFs will magnify the losses as well. If the underlying index, commodity, or currency declines by 10% in one trading day, the 2 times leverage ETF will decline by 20%. This leverage effect is achieved by using derivatives and other financial instruments to amplify the fund's performance. They're not considered long-term investment products. Leverage ETFs are short-term and can be exceptionally volatile, which is why they're not offered through MFDA dealer firms. The performance of a leveraged ETF relative to the underlying investment is reset, usually on a daily basis, which means their prices can deviate substantially over time. So not only are they risky because of the leverage multiple, but the effect of the daily performance reset can lead a leveraged ETF to deviate away from the underlying investment. And if that's not enough risk, the tendency of leveraged ETFs is, if held over time, to trend towards a negative performance, even before management fees and other expenses are factored in. Here's an example to illustrate. Suppose there is a leveraged ETF that provides 2 times exposure to the price of platinum, a precious metal. And let's assume the price for 1 ounce of platinum and the ETF unit are both $1,000 at the start of a very volatile week. Over the next 4 trading days, the price of platinum goes up by 10%, then down by 10%, then up by 10%, then down by 10%. And as a result, each day the 2 times exposure ETF goes up by 20%, then down by 20%, then up by 20%, and then down by 20%. The first instinct might be that the price of platinum and the leverage ETF should return to $1,000 by the end of the 4th trading day, since platinum had 2 positive days of 10% performance, which were immediately followed by 2 negative days of 10% performance. But in fact, the price of platinum is now down to $980, a loss of 2%. And the ETF unit price is down to $921.60, a loss of nearly 8%. Now, with any investment, a loss of 50% on one day would require a gain of 100% the next day just to break even. This is a key point in our platinum ETF example. A decline of 10% for the price of platinum on one day requires a gain of 11.1% on the next day, just to break even. For the 2 times leveraged ETF, a decline of 20% requires a gain of 25% the next day, just to break even. In fact, if the price of platinum continued with this trend of going up 10% one day, then down 10% the next day, after 100 trading days, the price of platinum would go from $1,000 to about $605, a drop of nearly 40%. So, if the leveraged ETF continues with that same up-down trend, but instead of 10%, it's going up 20% one day, then down 20% the next, after 100 trading days, the price of the ETF would go from $1,000 to about $130, a drop of 87%. And this doesn't include the management fees of the ETF, which will only drag the performance lower. Leveraged ETFs can provide some significant returns or some significant losses for investors in a very short period of time. But the mechanics of these funds make them unsuitable for any type of buy and hold strategy, and why MFDA dealer representatives are not permitted to offer them to their clients. In fact, a typical prospectus for a leveraged ETF, which resets daily, will state that there should be no expectations of achieving the intended leverage effect if the ETF is held for longer than one day.